All right, I'm here with Lyon, and he is an investment advisor with his own firm, Lyon Investment Group, right? And Lee, thank you for sharing with us, giving us about the market, what's happened since COVID-19 and all the fun things that have happened in the marketplace. Thank you for sharing with Wise Counsel members. So you've got some charts up here, Lee. Give us a little overview from these things that you've got, and they're going to have their handouts with them too. So
okay, thank you, John. So we're going to look at, we kind of all know where we've been to some extent, and the questions are, where are we now and where are we going? So what we're going to do is we're going to look at the economy, and we're going to look at 5 different components of what we call the market, the overall economy. And so we're going to express these in the terms of, we're going to use nautical gauges to kind of give you an indicator kind of where we've been and where we think we're going. So if you look at the first indicator, it's the economy. At the end of the first quarter, we were full negative. So anything neutral, straight up and down, is neutral. Everything to the left is negative. So we went from full negative in the first quarter to half full positive in the second quarter, looking forward. So that's been a huge improvement.
So we've already turned back the clock, you might say.
Right. We knew the second quarter was going to be awful, and it was. So that gauge, and I may have misspoke. This is the second quarter gauge. We were full negative. We knew the second quarter was going to be terrible, and the numbers coming out just this morning, consequently, are really even a little bit worse than we thought. But now that the second quarter is behind us, we're going into the third quarter. We're halfway full, thinking the economy is going to be in some recovery off of its lows in the second quarter. So that's a very bullish indicator, and that's what we're looking forward to in the third quarter. And we think there'll even be some additional improvement in the fourth quarter, and then through 2021. So if you look at the monetary policy, it never moved. It was the same in the second quarter, the same in the third quarter. And that is that we believe the feds are all in. They're doing everything they can do, and they're promising to do whatever it takes to provide liquidity to the markets, to provide quantitative easing, or buying assets that are distressed but there's no liquidity, and providing money and printing money. And they're all in. Their sleeves are rolled up, and they're doing everything they can do to keep the economy afloat. That's and it has been working. And I think right now that's important to do that.
Yeah.
We think there's probably some long-term consequences that we may not love, but right now, if they didn't do that, I think that it would be very, very difficult for the economy to even recover. I think we would lose industries maybe permanently.
Okay.
So we look at valuations, and that basically says, how are stocks valued? And so in the second quarter, we thought that they were valued a little bit undervalued, and we thought, we don't think that companies went from $100 in value to $70 in value in 2 weeks. But that's what the market did to them, and even worse. So we thought there was good value in the market in the second quarter. But we think that the market now is probably oversold, and that we're a little bit in the negative territory in valuation. So we think stocks are a little bit expensive. But what I want to tell you is that is not a timing mechanism. We don't use that as a timing mechanism. We think the valuations will catch up to the price, but we just think right now they're probably a little pricey compared to where they were in the second quarter.
So fear, does that enter into this whole thing?
Well, this comes into this next gauge. We call it investor sentiment.
Okay.
And so in the second quarter, it was all the way over to full.
Okay.
Which means that we consider that this is like an inverse indicator. So when investor sentiment is really, really, really at its worst, we think that's probably a pretty good time to buy.
Okay.
So the herd mentality. And we've seen behavioral investing has been very, very active, and it's been very, very bad. So for example, in March, we saw mutual fund sell-offs where investors were bailing out of stock or bond mutual funds to such a degree that there was nobody there to buy their shares.
Okay.
There was no liquidity. So it drove prices down even further. And the feds had to kind of step in and say, we will provide liquidity for bonds, for mutual funds, so that they can have liquidity. So if you're a mutual fund investor, you got hit with a declining market, plus you were affected pretty dramatically by behavioral investing. So we're not advocates of mutual fund investing. We actually are. We are pretty hostile towards mutual funds in this firm. We don't like mutual funds.
Okay.
And that's one of the reasons why. So, but right now, we think now investors now are kind of happy. We've had this nice recovery, the bounce back, and we think that is negative for the market. Investor sentiment is probably a better timing mechanism than just about anything else.
Yeah.
So now investors have had this recovery and they're feeling good about the markets and their portfolios, and we think that's not a great sign. It's not completely negative. It's just south of neutral. So It's not overplayed, but it's there. The second thing the last thing we look at is interest rates, and that's always been full bullish. We haven't moved that. Interest rates are low. If anything has happened between the first, second quarter, and moving forward, is we think that the Feds are saying the rates are going to stay low for a long, long time.
Okay.
And so we can't see on the horizon Feds increasing rates.
I mean, they even said the mortgage rates went down already again, down under 3%, right?
Yeah, we're basically in a negative, in a zero interest rate environment.
Yeah.
And so you just
Okay.
Yeah, we spent all the ammo that we have on interest rates. We can't go any lower. We could go to negative rate territory. That's another discussion. I don't really see that happening here.
Okay.
But right now we think that things are set to kind of move forward. We think the last 30 days, especially 45 days of recovery, we think that's probably going to flatline in the market. We think it's going to be more difficult moving forward than it has in the second quarter.
Okay.
And then the other thing I want to tell you is that we're getting a lot of bad news out this morning. The economy will improve before the news. Okay. So once we hear the news, we already know that. The markets already know that, and so once it's expressed, once you hear it, it sounds ominous and difficult. But the markets are already way past that. That's already priced in.
Okay.
Although we're seeing a rough start today in the market, but we'd expect that.
Yeah. Well, I mean, you've had all the bad news from the media about the fear and the cases and all that kind of stuff, and that you're saying that doesn't in fact affect the big investors as much as this smaller guy that's trying to cash out his bonds or whatever it might be, right?
Yeah, the behavioral investing is really detrimental to people's returns. And so the institutional investors, number one, they're not buying mutual funds. They're buying good assets and they're holding them. And that's what we advocate doing, buying good assets, good stocks, good bonds, and then holding them.
Yeah. So if I hear you right, then the investor or the institutional investor is the one that really drives the market.
Well, you would think so. So what they do is they ride things out. So they don't. A lot of what drives the market is irrational selling and irrational buying. Okay. And that really comes from more retail investors than it does institutional investors. Okay. So the institutional investors will kind of sit back and watch what's happening. But if you're in a mutual fund and you're subject to behavioral investing, you're taking losses because you own shares of a fund who's selling at very low prices. So if you own the individual's underlying security, it could be a volatility event, but you're not taking losses because you continue to own the securities through the market. But if you're in a mutual fund, you're taking losses even though you're disciplined, even though you're staying with your strategy. Other investors are not, so it's creating losses for you in the fund. And so even in bond funds in March, we saw sell-offs that we have never imagined that we would ever see. So people were selling really safe investments at a really, really bad time. And they were creating even deeper losses. And also really because there was just no liquidity. There was nobody out there to buy those bonds until the Feds stepped in. So what with the market, with travel really shut down and tourism shut down and all that kind of thing, what are the institutional investors, are they cashing out of those stocks, or are the individuals doing it too, or what's happening with that kind of thing? We're going to talk a little bit about that, but one of the things that we do is we don't react to what's happening in the market. We look at what we call relative strength modeling. So we kind of look at what we can forecast that we expect to happen in the market. So for example, if you go back to 2008, we started seeing weaknesses in financials during the 2008 crisis, and we just started exiting banks and financial institutions early in the year. And so we don't react to what's happening. We try to say, based on what's happening now, what do we expect in the future? And we will respond to that. So we will move assets around and reposition money, but we don't react to what's happening because we don't want to make bad decisions from an emotional standpoint. So we try to move from market weakness into market strength before they really materialize.
Okay.
And so more retail investors tend to react to what's already happened in the market. And
Okay.
it's just the worst thing you can do.
Yeah, okay. All right. Okay, let's stop right here.